Today, we are going to talk about a super important strategy for any business that has more than one owner. We're talking about how to protect the company you've worked so hard to build using something called a life insurance-funded buy-sell agreement. Now, I know that sounds a little technical, but trust me, it's one of the most powerful tools you can have to secure your legacy.
All right, let's just get right to it. I want you to think about something for a second. It might be a little uncomfortable, but it's so important. What would actually happen if your business partner died tomorrow?
It's a really tough thing to consider, but the reality can be pretty harsh. Without a rock-solid plan, that one single tragic event could put everything you've built at risk. I mean, all of a sudden, you could be dealing with legal chaos. Maybe you're forced to sell the company. Or worse, you're now in business with an heir who knows absolutely nothing about what you do. Your life's work, it could all be thrown into complete chaos.
So let's really break down the problem here. The core risk that every single partnership faces is the sudden, unplanned exit of a partner. This isn't just a personal tragedy. It can become a business catastrophe, and fast.
So what's the solution? Well, the foundation, the blueprint for navigating this kind of crisis is what's called a buy-sell agreement. Honestly, the best way to think of it is like a prenuptial agreement for your business. It's a legal contract that lays out exactly what happens to a partner's share when they leave. It takes all the guesswork, all the emotion out of what is already a very difficult situation.
Now here's where it gets really smart, because there are two essential pieces to this puzzle. The buy-sell agreement, that's your plan. It's the instruction manual. But hey, a plan is totally useless without the cash to actually make it happen, right? And that is where life insurance steps in. It provides the instant funding to bring that plan to life.
Okay, so you're probably wondering, how does this all actually work in the real world? Well, it's actually a surprisingly elegant and seamless process.
Let's walk through it. First, you and your partners get together and create that legal buy-sell agreement. Simple enough. Step 2, you take out life insurance policies on each other. Then, if the unthinkable happens and a partner passes away, the policy pays out a tax-free death benefit. And here's the final, crucial step. Those funds are then used to buy the deceased partner's share from their family. It's all clean, it's predetermined, and it's fully funded. No scrambling for cash.
Let's look at a real-world example to see just how powerful this is. Imagine a successful consulting firm. It's valued at $5 million, and it's owned by two 50-50 partners. When one partner passed away unexpectedly, the life insurance policy immediately gave the surviving partner a check for $2.5 million. That was the exact amount needed to buy out the other half of the business without skipping a beat.
And this is what creates the perfect win-win situation. The surviving partner gets to keep control of the company they poured their life into, and, at the same time, the deceased partner's family gets fair market value for their share, which gives them critical financial security during an unbelievably tough time. Everybody is taken care of.
Okay, so maybe you're thinking, all right, I'm sold. I need one of these. The next question is, how do you actually structure it? There are a couple of key options here, and the right one for you really just depends on your business.
So the two most common ways to do this are called cross-purchase and entity purchase. With a cross-purchase plan, each partner personally owns an insurance policy on the other partners. This works great for businesses with just a few owners. It's pretty simple and can have some nice tax benefits later on. But for larger businesses with a bunch of partners, an entity purchase is usually the way to go. In that case, the business itself owns one policy on each partner. It just keeps things from getting way too complicated. And, of course, for businesses with more complex situations, there's a third option, a hybrid agreement. You can think of this as a best-of-both-worlds approach. It lets you mix and match elements from the other two to create a solution that's perfectly tailored to your unique circumstances.
All right, let's wrap this all up by focusing on the real payoff here. It's so important to stop thinking of this as just another expense. It's not. You need to see it for what it truly is, a critical investment in securing the legacy that you have built from the ground up.
When you boil it down, there are four massive benefits. First, immediate liquidity. The cash shows up right when you need it most, without having to raid the company bank account. Second, fair value for your partner's heirs. It's guaranteed. Third, and this is huge, business continuity. It lets the surviving partners keep control and keep the doors open. And finally, the tax advantages are a really big deal, because that death benefit is typically received completely income tax-free. So who should be thinking about this? Honestly, this strategy is absolutely essential for any privately held business. We're talking about professional practices, law firms, dental offices, consulting agencies, really any partnership with two or more owners where a sudden exit could just blow everything up.
And
That brings us to the most important question of all. Now that you've seen how this simple yet incredibly powerful strategy works to protect your business, your partners, and your family, you really have to ask yourself, is your legacy protected?